Major funding for these broadcasts has been provided by grants from Bank of America, Merrill Lynch, and Perfect Building Maintenance, New York Community Bank, All Nation Renovation, Kilroy Architectural Windows, New York's Window Company, Greenberg Traurig, LLP. Additional funding has been provided by grants from AVR Realty Company, LLC, Beechwood Organization, Briarwood Organization, Capital One Bank, C.B. Richard Ellis, Cushman and Wakefield, the Dime Savings Bank of Williamsburg, Hal Fettner, Durst Fettner Residential, Stephen Napolitano, First American Title Insurance Company, Friedman, LLP, Gemini Real Estate Advisors, LLC, Genova, Burns and Gian Tomasi, Grubb and Ellis, Investors Savings Bank, Jack Jaffa and Associates Real Estate Consultants, James D. Kuhn Real Estate Institute at Syracuse University, Madison Realty Capital, Markham LLP, Marcus Millichap Real Estate Investment Services, Margolin Weiner and Evans LLP, Massey Knackle Realty Services, M&T Bank, Meridian Capital Group, Moynihan Group, Newmark Knight Frank, Orphanides and Associates, Sterling and Sterling, Urban American, the Wickoff Group.
Hello, my name is Michael Stoller. So here we are, fall of 2010. Some people in the last couple of shows saying that the world is getting really bright. The stars are aligned. And I, Dr. Doom and Gloom, still, no, I'm not that positive. I'm a little cautious. So I don't know. I've really brought together today this group of distinguished business real estate leaders to provide their insight on the state of the market. They're a unique group. They're bankers, they're financing brokers, they're owners, they're developers. And my guests, they include Gino Martocci, the regional president for New York and Long Island for M&T Bank. Jeffrey Levine, the chairman CEO of Levine Builders and Douglaston Development. Ralph Hertzker, the president and CEO of the Meridian Capital Group. And last but never least, a man who's been on the show many, many times, nearly as much as Mr. Levine, Stephen Witkoff, the CEO, chairman, Grand Poupard of the Witkoff organization. So, Mr. Witkoff, a year ago at the opening of my 9th season, now I'm happy to celebrate my 10th season with friends. How do you look at the market? I mean, speaking before, you weren't that positive, You didn't sound like Norman Stern of being the positive. So tell me. Guess I'm going to shine my apple. Maybe it's getting better.
I think, as we were talking about before, I think that things are certainly better in New York for sure. We look not just in New York but in other areas, Michael, as you know. But I think New York is clearly better. How much better? I don't know. But it's certainly better than it was a year ago, that's for sure.
Gino, you see it in a different perspective. I mean, you have a large portfolio, you're running a large bank over here. How do you see the market? Because people are coming, like a Steve Witkoff will come to you for a loan, a Jeff Levine will come for your loan, Ralph Hertzker will bring some of his clients to you for a loan. What are you seeing?
It's certainly better than it was a year ago. There's activity, you can underwrite loans. The residential market, as you were talking about earlier, is quite strong. There's activity on office leasing. There's a little bit of development that's out there, and so the present looks really good. As you look forward into 2011 and 12, I think probably the biggest question is around political uncertainty, and some of the more structural problems that don't seem to be being addressed.
So how do you, as a banker, when somebody like a Witkoff or Levine or Ralph come to you, how do you look at a deal today? I mean, things are looking brighter, but you have to still be cautious in your decisions because you have the banks responsibility.
We tend to be, sort of bottom up, so we're very fundamentally focused on the bricks and who we're doing business with. So if all that aligns, and we're making loans certainly to anybody that would be in this room.
Now, but bricks do not mean cash flow.
Right.
That's the big question.
Yep.
And that's the market.
Well, what you're underwriting today is existing cash flow. There's none of this sort of prospective income ideas or ever rising rents. I mean, that we didn't really underwrite that way anyway, and those that did aren't lending very much today usually.
Ralph, what are you seeing out there by the other lenders? Because there are the finance companies, the capital companies, there are the commercial banks, there are the savings banks, and then there's those evil people coming back to the market, the bad people, and not bad people, just the bad situation, the CMBS, the collateralized mortgage stock. What are you seeing?
Well, we're seeing a lot of activity in all sectors, and I think what Gino said is exactly correct. I mean, all lenders today are focusing on current cash flow. I think who the borrower is as important as it always was to the lenders that are around and surviving. I don't agree with you that the CMBS market is evil. I think that it's a certain sector that caters to a certain client base, and I think that, like anything else, everything just got out of hand, and the guys on Wall Street were just very aggressive at looking at future values, and for many years it did work. I think the banks here in New York specifically that always looked at current cash flow didn't get caught with any disasters. And I think the rating agencies are back and they're rating current cash flows, and there was a huge appetite by investors to buy the paper, because making a loan in this market, you're doing it in low values and you're still doing it on current cash flows.
Given the level of maturities that are out there, ultimately it's a good thing for the market. We need this level of liquidity to come back in. The commercial banks, given the capital sort of constraints that they have and increasing demands on capital, regulatory capital, there's no way the banks can absorb all of this maturity.
I'm not disagreeing that we need it. The whole question is I don't want it to come back with the underwriting being, rather loose and goosey.
Wholeheartedly agree.
In that manner. That's all I'm saying. I said there's definitely, because there's no one who's going to be able to meet all of the loans that are coming up, for renewal.
I heard yesterday there's $1.4 trillion of debt maturing in the next 2 years. It needs many banks, many Wall Street firms, many new finance companies to absorb that and recirculate that into new long-term financing. And I think it's a healthy situation.
You're a developer. You're an operator. True, developer, operator. If you don't build, you don't have anything to do. I mean, so what are you doing these days? I mean, you got a very nice, successful project in Williamsburg, probably one of the best, The Edge. You have a property called the Ohm, on 30th Street on the west side. So, after these two things are leased and sold, what are you going to do? You're going to retire down to Boca with Witkoff over here?
Miami.
I'm not ready to retire. I'm very fortunate. As you know, I love what I do. Building's been very good to me, as they say in baseball. And in the final analysis, everything we've done, I'm the optimist of the group always, as you know. The past year, I think, is one of the best years in recent real estate history. And that may sound bizarre from where we were to where we are. But last fall, we were all looking at continuing doom and gloom. And on almost every level, we never would have expected residential rentals to be where they are on a price per square foot as they are today. The low interest rates continue to increase that ever important cash flow line that you just spoke of. So in many respects, we're far better off this year, this fall, than we were last fall. Going forward, obviously, those of us who are still alive, as we like to say, in the real estate business, as Steve said before when we were speaking, if you've been a good borrower, a good payer, if you've been honest and capable, you can do loans on intelligent deals. The trick is not to get over anxious, not to be wrong in your underwriting, and to do deals that you can finance with a reasonable amount of equity, because I think from here, real estate has bottomed, certainly in New York. Unlike the rest of the country and in other parts of the country, I would not be so confident, whether it be Phoenix or Vegas or Florida.
I don't have to go that far. I can go to New Jersey.
Absolutely.
The office market in New Jersey has not recovered, and it's not recovering. Westchester is a similar situation. Steve, let's look at it, and a little bit relating to what Jeff just said. When you went into business, when you left the law practice and you started buying with Larry these buildings, you were buying at a certain rent multiple and a certain cap rate. Today, buildings in the neighborhoods that you bought, north of 96th Street, in the Bronx and other areas, are once again selling at cap rates and multiples that haven't been seen in the last couple of years. Aren't you a little worried about that? I mean, they're selling at 5, and when the reality is, Ralph, the brokers tell you it's 5, but when it comes down, they're really at 3, at 3.5. And, some of the rents aren't being paid in the Bronx. People are still hurting in the boroughs. Not everybody's the uppie over there.
When Larry and I started buying, Mike, in 1986, we were paying, that was the high point of the cycle for us, we were paying 4 times the gross rent. And in 91 to 95, we could have bought 2,000 apartments at somewhere in the neighborhood of a multiple to 2 multiples of the gross rent roll in those days.
And now I'm hearing about 10-time multiple.
And I'll say this to you too, and we fervently, we understand this. What no one understood back then, even when you bought at those reduced numbers, the credit risk. And the credit risk, because, and I say it all the time, if you're a working class person, and your choice is to put food on the table for your kids, or buy diapers for your children, or pay the landlord, what are you going to do? You're going to put food on the table. And we were good, decent landlords, Larry and I. I mean, we had an exceptional reputation because we understood that, and we were sensitive towards that. But I would imagine if you go down to 111 Center Street today, you're going to see, a landlord-tenant court that's over-revved like it was in the early 1990s, because there are issues out there and people are stressed.
But what I'm saying to you, Steve, is that people want to buy apartments. That's really the item that people are going to, and they're looking for financing. That's the hot item. Now, who's not buying those apartments? The large private equity funds aren't buying those apartments, partially because it's not responsible when they have pension investments who are governmental pension funds.
But
so they can't buy those apartments anymore.
Yeah, but they want to buy apartments at a number. I mean, we'd buy anything in the boroughs. We like the boroughs, but we like the boroughs.
I think people are looking at stabilized rent as bonds, because the reality is interest rates are so low on all bonds that you can afford to pay a higher multiple or higher gross if, in fact, you're going to achieve even a 2 or 3% return, unfortunately. It is very stable. The housing stock, it's hard to replace. Much of it is regulated, and in fact, it is a bond that pays a very low interest if you buy it at the right price. It's not the craziness that went on 3 and 4 years ago, where people were paying 13 and 14 times gross rent, thinking that there were all kinds of tricks of the trade, whether it's rent increases as a result of improvements, or it's turning some of these existing buildings, walk-ups, into condos. People were getting a little crazy, just like in the CMBS market, but that's all gone now.
Now, what about, Gino, people are coming to you, are you entertaining new condominium developments? Because that word was a word like in an article that I recently wrote, and I quoted somebody that they said construction loans were like the cocaine of the business. It was an evil situation.
On a highly selective basis, we are entertaining condominium construction loans. In fact, we'll close one this week for a very well-heeled developer.
Well-heeled developer, a lot of money in the deal, good location. All the stars, everything was lined in the proper way. What are you seeing? I mean, where are you looking? Are you back in the boroughs?
Well, we're looking
back where you started?
We're working diligently in the affordable housing sector. We have tied up a number of properties that we are working through various programs so that we can keep our development and construction forces busy, while the private sector and the financing is frankly too expensive, with the outcomes somewhat questionable. It's hard to attract. Remember, years ago, you could do very large jobs with very little equity through the miracles of structured finance. Structured financing has left the room for the moment. It will come back when prices come back, in my opinion.
Now, you say structured finance has left the business, but there is Starwood, there's Winthrop, there's Ladder, there's Goldman Sachs, there's this Cantor Fitzgerald. That's a market, that's a lending source. It's not your source because it's a little more expensive. What are they doing, those type of guys in that market?
Well, I think in any situation like you had over the last 12 months where there was value-added creation in buying distressed debt, a lot of these funds were financing that, which was not traditional bank financing. They are moving into the CMBS world, which I mentioned before, is coming back.
No, but they're putting their loans hopefully into CMBS, but they're also lending. I mean,
People are buying fractured condos from a bank or from a failed developer, and there's a tremendous amount of equity going in. I mean, just to comment on your comment, which what Steve said before, buying in the Bronx, a lot of the money that's going into the Bronx today is old families that sold to the opportunity funds at huge multiples and are now coming back with a tremendous amount of equity. So the difference is, when people pay 13 times the rent, 3 years ago and got 10 times, today if you're paying 10 times, you're getting 5 times of financing. So you're seeing deals with tremendous amount of equity going into them today. And I think it's exactly, what Jeff said. It's steady cash flow. I have one client and he says, I own thousands of units and it's recession proof because everyone gets up every day, goes to work. And it proved itself in this market. It is really recession proof, except for some of the high end rents in New York, which we've seen come back. The boroughs have held up amazingly. And I think that sector is strong. That sector is very financeable.
What about the office market, Steve? I mean, you're in the office business. What are you seeing?
I think rents are soft. I mean, we're taking space now, negotiating a lease, and
You're moving?
yeah, we're moving. And there were plenty of places for us to pick from. And so that's why we haven't been all that active in the office buying business out there. It's hard to.
I mean, but there were 50 leases signed in excess of 50,000 square feet in the first 6 months of this year.
Well, no, look, I'm not negative on. I think New York is good. New York is better. I mean.
But you're saying that there are still opportunities out there for a tenant in the office space, perhaps not as much on the A space, but perhaps for the B or B plus space.
Well, for sure, in the B and B plus market, there is a huge opportunity. I think you can do deals. It's just amazing. I think you can do deals in the B market in the 20s today in Midtown, not even downtown. I mean, that's pretty exceptional, which may well be a growth engine for this town. I mean, now you've got rents where small startups can come in and they can take space, and it's not onerous on them.
It's kind of what doesn't kill you will cure you. The bottom line is,
absolutely,
in general, we become more competitive, not only in our office space, in our residential space, and it makes it more opportunistic for businesses to come here and create jobs. And we all know that it's the economy and the jobs that are the fuel which causes real estate to burn.
Yeah.
Now, Ralph, you operate downtown, and you were saying part of the show that you see a lot of vibrancy in the lower Manhattan market.
I come to work every Sunday, and for many years it was quiet. The garages weren't open. Now you come in, you see families. I mean, it's just unbelievable, the change. I mean, a lot of the buildings that went from office to condos or to rentals are just doing very well. I mean, you walk around at night, you see families, you see restaurants. Even we're down the block from Goldman Sachs. Everyone thought when they'd move away, to the other side of lower Manhattan, it would be really doomsday, and it's still very vibrant.
But they do have a vacant building that they have to fill
Yes.
up. And you also have the AIG buildings over there that have to been going up. As a banker, how do you look at lower Manhattan today?
Well, it's difficult to make some of the numbers work on these large buildings, but vacancy actually fell, I think, for the last month, and it was positive absorption.
No, but
downtown.
I'm talking in general. If someone came to you for a transaction in lower Manhattan, do you think you and your credit committee would be that positive, or cautious?
It's going to come down to the individual and the structure of the deal. I mean, if there's lots of equity in the deal and you can see a way for the deal to work, absolutely.
I mean, you've done things then. What do you think about lower Manhattan?
I mean, absolutely. Everything has a price point at which it will rent or sell. And if you acknowledge the proper price point and the pro formas pencil out, I think it's a wonderful place. It's becoming more vital, as Ralph has said. The commutation from there, again, I always go back to jobs. Great commutation from Wall Street, either to jobs locally or via trains and buses, uptown, everything is at your fingertips.
Yeah, with lower Manhattan, it's interesting because this, in a place that, do you own the space at Cipriani?
We own the condos there.
I know, but what about the
event space?
The event
No,
space.
that's the event space is just Giuseppe's. That's his
Okay,
event space.
so the
business.
event space in November, Mr. Levine is being honored by a great charity, and people go down to the event space. It's really busy down there over on the situation. Now, the big question is, will the vibrancy, because Condé Nast will probably move downtown. Douglas Durst was in China. He's looking, to get other tenants, and people want to go down there because, people want environmentally green buildings and all the situation. How do you see, especially downtown in the hospitality? I was trying to tie in the hotel, because you just finished the hotel and you have a little interest in the hotel, right?
Absolutely. We just opened up the Gansevoort Park Hotel on 29th Street and Park Avenue South, and thank God it's doing wonderful out of the box. It's a wonderful facility geared more towards the uptown business as well as the downtown social set. And I think the hotel sector, along with the economy, is reviving very well. I think that average daily rents have moved up quite a bit. And there is a need for more hotel space downtown, but it's quite difficult, frankly, to finance it in this market.
Ralph, have you financed any hotels recently?
Not much. I mean, we're in the market now with a couple, very low leverage, very strong sponsorship. Definitely not construction of hotels. I mean,
Now, Gino, you've been rather successful in the market, and you're even in construction right now on a hotel like on 13th Street, I believe.
Not under construction just yet, but soon. We actually like the hotel market when properly done. You can't. The key to owning a hotel is operating a hotel and not over leveraging the hotel. You got to survive through cycles, and we never believed sort of this $500,000 and $600,000 a room construction cost, or $1 million a room or a key construction cost. So all of our stuff is sort of sub $225,000 a key. And a lot of it's 90% occupied, and rates have gone up over the last year. So we're actually pretty comfortable, or very comfortable, with our hotel exposure at this point, and the trending has been very strong for really since March of.
Now, Ralph was saying before, one of his clients had seen some land in Long Island City, and needless to say, you can't get a land loan today. It's not something that many banks want to really do. Would you buy land today?
We would. We would. But, that's the problem. Land's traded up now. There's a great, Jeff will tell you, I mean, he's more in the business, but there's a great opportunity on construction costs. And so.
There's no question
But
construction
land's
costs are
traded
down
up.
20% over the last 2 to 3 years.
Right.
Land has traded up, but there really hasn't been many transactions because there are a lot of pretenders trying to buy property where ultimately they don't have the capacity really to finance deals of any magnitude. So the bottom line is you got to stick to it, and you got to go out there and try to buy property at a price point where you can finance and build it, because otherwise you're going to be back in the market again in 2 years trying to sell the property again.
What about this big terminology, distressed debt? I mean, are the banks selling distressed debt, Ralph? Do you see the banks?
not as much as what here in New York. There's really very little going on. There's been a handful of deals that I think people have spoken about. Across the country, you're seeing more of that.
But here, you don't see it that
You're
much.
going to see a couple of deals or a couple of large deals that traded, and they were
At
just
par.
very
in many
close to
cases.
par. Very, very
I mean,
close
the
to par.
reality is, because of the extremely low cost of money, many banks, rather than write off these loans, can play the kick the can or the extend and pretend game that we all talk about, and hope that things get better because it's not costing them much to get out into the future. And I think if you believe that certainly housing has already hit bottom, is increasing as we speak. I can't speak for the commercial office market. I think there's much too much vacant property out there for me to expect that to improve greatly, and I think that's where the biggest problems lie in the future. But generally, when it comes to my sector, the residential sector, I sincerely believe that the banks are not letting go of these properties as long as they have capable and honest people operating them, and that's a different story. They may in fact make a change if they don't have good operators, but ultimately it's not percolating through the market yet.
Now, what about, I mean, at one time, you owned buildings in New Jersey, Newark, right?
Mm-hmm.
You still own anything?
No.
What's your thought about Newark? I mean, you got Cory Booker over there, they say he's doing a great job, Do you see anything? Would you go back into Newark or New Jersey to buy something?
I mean, we would at the right price point, sure.
I think Steve is looking at the Jersey Shore.
Exactly. I watched that show.
No,
I actually watched it for the first time because I heard people talking about it.
Now, I think you're not looking, I think many people say the Gold Coast, which is Jersey City and Hoboken, which is a different market because it's really, people consider that like an extension of the market. Now, you're still bullish? Do you think any new development could take place in Williamsburg today?
Oh, absolutely. There's Williamsburg, while it was subject to a wonderful rezoning by City Planning Commissioner Mayor Bloomberg, it's limited. There are only a few waterfront sites in all of Williamsburg. The inland properties have virtually all been sold because they've been on the market for 3 and 4 years. So I think that once the psychology of the buyers changes, as it appears to be doing this spring and this fall.
I'm talking about new development, huh?
Yes, I believe that as the comps exist, for instance, we are closing units in Williamsburg right now. That was the subject of great fear for our lenders because they were concerned, will the comps work? Will the permanent lenders step up? And the fact of the matter is, the lenders are stepping up. We happen to be Fannie Mae and Freddie Mac approved. The banks are closing, and the comps are being supported. So I think that will continue as long as the economy continues to improve.
What kind of pricing, Jeff?
Well, I can tell you that before Lehman, we were averaging $950 a foot. When I say before Lehman, we all know what I mean. Post-Lehman, that average price has fallen to approximately $850, so it's blended close to $900 as we speak. But we have a great product, forgive me for advertising again, and people recognize where value is. Again, 25-year tax abatements, these are all factors in the marketplace today. And I do believe if, again, you have an intelligently designed product for the right market, you will sell. And Williamsburg is the destination of choice for many of the young people in that Generation X and Generation Y 25 to 40 range
What about
today.
the other part of Brooklyn? Ralph, you live in Brooklyn. You know, you see, I mean, I took a ride through the old neighborhoods. It's booming.
Booming.
You know,
Shipsy Bay, Ocean Parkway, Midwood. I mean, the whole area. Everything is. I mean, Prospect Park.
Well-located stuff is selling, and there's not a lot of product. Even if you look into the suburbs, into Rye and Scarsdale, they have less than 3 months' supply of homes there. I mean, there's no product, and people are selling, and rates are low. People have jobs, and the decline in jobs this cycle was less than the previous 2 recessions in New York City. So that's driving a lot of this.
So, you know, my apple is getting a little shinier. Dr. Doom and Gloom is getting a little positive because I've heard some positive, very positive, in general comments from my friends today. I'd like to thank Gino Martocci, Jeff Levine, Ralph Hertzker, and Steve Witkoff. See you next week.
Major funding for these broadcasts has been provided by grants from Bank of America, Merrill Lynch, and Perfect Building Maintenance, New York Community Bank, All Nation Renovation, Kilroy Architectural Windows, New York's Window Company, Greenberg Traurig, LLP. Additional funding has been provided by grants from AVR Realty Company, LLC, Beechwood Organization, Briarwood Organization, Capital One Bank, C.B. Richard Ellis, Cushman & Wakefield, the Dime Savings Bank of Williamsburg, Hal Fettner, Durst Fettner Residential, Stephen Napolitano, First American Title Insurance Company, Friedman, LLP, Gemini Real Estate Advisors, LLC, Genova, Burns and Gian Tomasi, Grubb and Ellis, Investors Savings Bank, Jack Jaffa and Associates Real Estate Consultants, James D. Kuhn Real Estate Institute at Syracuse University, Madison Realty Capital, Markham LLP, Marcus Millichap Real Estate Investment Services, Margolin Weiner and Evans LLP, Massey Knackle Realty Services, M&T Bank, Meridian Capital Group, Moynihan Group, Newmark Knight Frank, Orphanides and Associates, Sterling and Sterling, Urban American, the Wickoff Group.